Trading by Professional Traders, an Experiment. Marco Cipriani, Roberta De Filippis, Antonio Guarino, Ryan Kendall. Staff Report Number 939. August 2020. This paper presents preliminary findings and is being distributed to economists and other interested readers solely to stimulate discussion and elicit comments. The views expressed in this paper are those of the authors and do not necessarily reflect the position of the Federal Reserve Bank of New York or the Federal Reserve System. Any errors or omissions are the responsibility of the authors. Abstract. We examine how professional traders behave in two financial market experiments. We contrast professional traders' behavior to that of undergraduate students, the typical experimental subject pool. In our first experiment, both sets of participants trade an asset over multiple periods after receiving private information about its value. Second, participants play the guessing game. Finally, they play a novel, individual-level version of the guessing game and we collect data on their cognitive abilities, risk preferences, and confidence levels. We find three differences between traders and students. Traders do not generate the price bubbles observed in previous studies with student subjects. Traders aggregate private information better, and traders show higher levels of strategic sophistication in the guessing game. Rather than reflecting differences in cognitive abilities or other individual characteristics, these results point to the impact of traders on the job learning and traders' beliefs about their peers' strategic sophistication. Keywords: bubbles, experiments, financial markets, information aggregation, professional traders, strategic sophistication. 1. Introduction. Experimental studies of financial markets have complemented empirical work using field data from real-world markets since at least the 1980s. For example, Plot and Sunder, 1982, Friedman et al., 1984, Smith et al., 1988. An important question as to what extent the behavior of undergraduate students in the laboratory is representative of the choices made by professional traders. In this paper, we address this issue by running a series of laboratory market experiments with a sample of professional traders and portfolio managers working in the City of London, UK. 1. As a control, we repeat the same experiment with the standard experimental subjects, namely, undergraduate students. Studying the behavior of professional traders can help us to make progress in understanding financial markets. There are several reasons to conjecture that traders may behave differently from students. They might have different levels of strategic sophistication or might entertain different beliefs about other subjects. Furthermore, they might be different in individual level traits in terms of cognitive abilities and behavioral biases. Some of these differences may be due to selection, others to training. 2. We focus on three classical strands of the experimental finance literature: the literature on bubbles in markets started by Smith et al., 1988, the literature on private information aggregation started by Plot and Sunder, 1988, and the literature on guessing games, also known as P-Beauty contest games, started by Nagel, 1995. Often, with undergraduate subjects, these experiments document substantial deviations from equilibrium predictions. First, in market experiments, subjects rarely trade at the equilibrium price. Instead, they typically overprice the asset, a phenomenon often referred to as bubbles. See Palin, 2013, for a survey which is only corrected at the end of the experiment when the bubble bursts. Second, in experiments with private information, the information aggregation is sometimes incomplete. See Sunder, 1992, for a survey and Corgnet et al., 2015, for a recent study. Third, in the celebrated guessing game, subjects choose numbers far from the Nash equilibrium, reflecting either limited depth of reasoning or low beliefs about others' depth of reasoning. See Agranov et al., 2012, and Agranov et al., 2015 for recent studies. We run 3 experiments. Our experimental design, while borrowing from past studies, presents several novelties. In our first experiment, the trading game, subjects trade an asset that earns dividends over multiple periods in a continuous double auction. Our experimental asset market innovates with respect to the standard setup by introducing private information about the asset's fundamental value. Our study essentially combines elements of the classic bubble experiments with elements of the experiments on information aggregation, started by Plot and Sunder, 1988. To the best of our knowledge, ours is the first study in which the problem of private information aggregation is studied in a multi-period setup, rather than in a market in which the asset lives for only one period. 3. Finally, there are gains from trade in our economy, as in Plot and Sunder, 1982, Friedman et al., 1984, and Kassin and Friedman, 1997. In our second experiment, the guessing game, Nagel, 1995, each subject chooses one number and the winner is the subject whose number is closest to a fraction, 2/3 in our case, of the average. Although this is not a financial market in a strict sense, subjects earn money by outguessing the others. This is a common feature of financial markets where traders have to think about where the market goes to make a profit. As Keynes 1937-2018, p. 99 writes, he actual, private object of the most skilled investment today is to beat the gun, as the Americans so well express it, to outwit the crowd, and to pass the bad, or depreciating, half-crown to the other fellow. 4. A voluminous literature has shown that student subjects choose numbers far away from the Nash equilibrium. This may be due either to subjects' limited depth of reasoning or to beliefs about other subjects' level of reasoning. In order to disentangle these two explanations, we complement this celebrated experiment with a novel, individual-level version of the guessing game, in which strategic considerations do not matter, only subjects' understanding of the game does. In this individual guessing game, we ask each subject to choose 8 numbers and then we pay them if a randomly selected number among them is equal to 2/3 of the average. Comparing the results of the guessing game to those of the individual guessing game, we are able to separate subjects' ability to solve the game from subjects' beliefs about the other's strategies. Finally, after subjects complete these experiments, they execute a series of individual-level tasks measuring cognitive abilities, Raven IQ test and cognitive reflection test, as well as tasks to elicit risk aversion and overconfidence. The results of our study are easy to summarize. 1. Professional traders do not produce the classic bubble pattern observed with students. Instead, they trade at prices that track the fundamental value rather closely. 2. Professional traders aggregate private information better than students. 3. Professional traders choose numbers significantly closer to the Nash equilibrium than students. This is driven, at least partially, by the fact that traders believe that their peers are strategically sophisticated, whereas students do not. These remarkable differences are not due to traders' superior cognitive abilities, for example, arising from selection into the banking and finance industry. In fact, we find that students perform as well as traders in the cognitive reflection test and slightly better in the Raven's IQ test. Moreover, traders are as confident as students. Indeed, neither group is overconfident, hence overconfidence cannot explain our results. Finally, since traders show less risk aversion than students, risk preferences cannot explain why students engage in bubble behavior whereas traders do not. Taken together, these results imply that the differences between traders and students we observe in our financial market experiments may be due to on-the-job learning, including learning about the strategic sophistication of one's peers. There are only a few experimental papers using professionals, and no experiments on financial market bubbles using exclusively professional traders. The seminal paper by Smith et al., 1988, include one session with professional and business people. 5. King et al., 1993, include one session with over-the-counter traders. Bubbles are observed in both experiments. It is important to notice that in both papers there is only one session with professionals. Moreover, subjects in the professional session of Smith et al., 1988, are professionals in general, not professional traders, and the 6 trader subjects in King et al.'s 1993 professional session play together with experimenters 3 out of 9 subjects. Finally, a recent paper by Weitzel et al., 2020, uses financial professionals in a market experiment. They observe bubbles with both students and financial professionals, although with financial professionals bubbles are less pronounced. It is important to remark that the subjects in Weitzel et al. 2020 are also financial professionals in general, and are not necessarily directly involved in trading or investing as in our experiment. Financial professionals in general do not necessarily have trading experience and may trade very differently from professional traders. In terms of information aggregation, there are two related papers using financial professionals. Alivi et al. 2007 run an experiment on informational cascades based on the model of Bikhchandani et al. 1992 that is, not a financial market experiment. They find that financial professionals rely on their private information to a greater extent than student subjects do, and, as a result, fewer cascades form in the laboratory. Cipriani and Guarino 2009 use financial professionals to study herd behavior in a sequential trading financial market, based on Gloston and Milgram, 1985. They find that information aggregation by financial professionals is similar to that of previous work with student subjects Cipriani and Guarino, 2005. Finally, we are not aware of guessing game experiments with financial professionals. Within the class of dominance solvable games to which the guessing game belongs, experiments by Palacios Huerta and Voli 2009, and Levitt et al. 2011 study the behavior of professional chess players in the centipede game and in the race to 100 game. The rest of the paper is organized as follows. Section 2 describes the games used in the experiment along with equilibrium predictions. Section 3 provides details about our subject pool. Section 4 presents our main results pertaining to different behavior in the market games. Section 4.3 compares traders and students in terms of individual level traits, for example, cognitive abilities. Section 5 concludes and Section 6 contains the instructions and additional material referred to throughout the paper. 2. The experiment. In our experiment, subjects participate in 1. The trading game, 2. The guessing game, 3. The individual guessing game, 4. Individual level tasks aim to infer their cognitive abilities, risk preferences, and confidence. 6. 2.1. The trading game. We first provide a simple model of the trading game and then describe the procedures that we use to implement it in the laboratory. 2.1.1. Setup. We consider a market with a continuum of traders who trade a risky asset. Time is discrete and indexed by t equals 1, 2, 10. The numeraire is cash. Traders are risk neutral and do not discount the future. At each period t, the asset yields dividends dt equal to 50 or 150 with equal probability. Dividends are independently distributed over time. The asset has no residual value after period 10. The realization of the dividends is unknown to traders. In each period t, however, they receive noisy private information about the value of the current dividend dt in the form of a symmetric binary signal with precision 0.75. In particular, each trader I receives a signal SIT distributed as PR, SIT equals 0, DT equals 50, equals PR, SIT equals 1, DT equals 150, equals 0.75. Conditional on the dividend value, signals are independently distributed. Note that the signal is only informative about the dividend in the current period, not about future dividends. At the beginning of the period, half of the traders are selected to pay a fee of 50 for each asset held in their portfolio at the end of the period. Whether a trader has to pay a fee in a given period is independent of whether they had to pay it in previous periods. In period t equals 1, each trader has an endowment of 3 assets and 7,000 of cash. After trading in period t and receiving the dividend, the portfolio of cash and assets carries over to period t plus 1. 2.1.2. Equilibrium prediction. In the rational expectations equilibrium (REE) of the model, the price is equal to the asset's fundamental value, that is, the expected value of current and future dividends. At each period t, private signals are perfectly aggregated by the price. Moreover, in each period, all traders who have to pay a fee for holding the asset at the end of the period sell it to those who do not pay the fee, thereby realizing all the gains from trades. In particular, in period 1, demand and supply clear the market for a price of 950 when D1 equals 50 and for a price of 1050 when D1 equals 150. See figure 6.1 in appendix. The equilibrium price is equal to the sum of the expected value of dividends in all subsequent 9 periods, 100 times 9 equals 900, and the realized dividend in period 1, 50 or 150. The same logic applies to any subsequent period. Equilibrium prices are reported in Table 1. Note that the equilibrium price of the asset is weakly decreasing over time. Between time t and time t plus 1, it decreases by 100 when the dividend is either 150 or 50 in both periods t and t plus 1, or by 200 when the dividend is 150 in period t and 50 in period t plus 1, or it remains constant when the dividend is 50 in period t and 150 in period t plus 1. Table 1. REE by period and dividend realization. 2.1.3. Trading in the laboratory. In the experiment, we have 8 subjects acting as traders. At the beginning of period 1, each subject receives an endowment of 3 assets and 7,000 experimental currency units (ECU). Subjects receive a private signal at the beginning of each period. Specifically, when the dividend is equal to 150, 6 subjects observe a blue ball, and 2 subjects a red ball. When the dividend is equal to 50, 6 subjects observe a red ball, and 2 subjects a blue ball. This signal structure guarantees that, in each period, private signals jointly reveal the dividend even if the number of subjects is finite. 7. At the beginning of each period, subjects also learn whether they are fee-paying or non-fee-paying subjects for that period. In each period, subjects trade for 150 seconds in a double auction market. They post offers to sell or buy one asset. To post a sell offer, a subject enters the minimum price they are willing to accept and clicks on a sell button. The offer appears immediately on everyone's screen, in a column labeled Sell Offers. The identity of the subject making the offer is not revealed. Similarly, to post a buy offer, a subject enters the maximum price they are willing to pay and clicks on a buy button. A trade is automatically executed whenever the lowest sell offer ask is lower than the highest buy offer bid. 8. Subjects can also buy or sell by clicking on a buy or on a sell button, which automatically accept the best outstanding sell or buy offer. Each subject can post a maximum number of sell offers equal to the number of assets held in his portfolio. Moreover, the sum of all the outstanding buy offers cannot exceed the cash held in his portfolio. At any time, a subject can withdraw outstanding buy or sell offers that have not already been executed by clicking a button labeled Cancel. A subject's screen displays their current portfolio of cash and assets, the list of past trades with their own executed trades highlighted, all the outstanding bid and ask prices, and the time left before the end of the period. See sections 6.13 and 6.14 for instructions and decision screenshots. At the end of each period, subjects are informed about the dividends realization and their end-of-period portfolio. Changes in the portfolio between 2 periods are due to the dividends earned, the fee payments, and the profits or losses from trading. The portfolio at the end of a period carries over to the next period. After one period ends, trading in the following period starts, according to the same rules, until all 10 periods are completed. 2.2. The guessing game. After the trading game, subjects play the standard guessing game (GG). Nagel, 1995. Each subject chooses one number in 0, 100. Subjects are asked to guess a number as close as possible to a target number, defined as 2/3 of the average of the 8 numbers entered by all the subjects. 2/3 is a standard target, used in Nagel's original paper too. The subject whose number is closest to the target number earns £5, the others earn nothing. In the case of a tie, the amount is equally split. The decision screenshot is in section 6.6. The only Nash equilibrium of the game is all subjects choosing 0. The most common interpretive framework for behavior in the guessing game is level K theory. A subject who chooses randomly in 0, 100 is said to be a level 0 subject. A subject who believes that all other subjects are level 0 and best responds on the basis of this belief is said to be a level 1 subject. since a level 1 subject believes that other subjects choose, on average, 50, their best response is to choose 31.8. 9. If a subject believes that all other subjects are level 1 and best responds accordingly, they choose 21.2 and are said to be a level 2 subject. In general, a level K subject is one who best responds to the belief that others are level K1 subjects. When K tends to infinity, the best response converges to the Nash equilibrium action. 2.3. The individual guessing game. After this standard GG, we ask subjects to take part in a modified, individual level version of the GG. In this individual guessing game IGG, each subject chooses 8 numbers and the target number is 2/3 times the average of these 8 numbers. One of the subject's 8 chosen numbers is randomly selected for payment and, if it equals the target number, the subject earns £5. The decision screenshot is in section 6.7. As we explained above, according to level K theory, subjects with higher levels of strategic reasoning choose lower numbers in the GG. However, for any choice in the GG between 1 and 50, one cannot disentangle a subject's level of reasoning from the subject's belief about other subjects' levels of reasoning. For instance, suppose a subject chooses 31.8 and is, therefore, classified as a level 1 subject. This choice could be because the subject lacks the ability to reason past level 1, or it could be because, although the subject does have such an ability, they believe that other subjects are level 0 subjects. Our novel IGG disentangles one's own ability and their belief about the ability of others. In particular, in the IGG, the only 8 numbers that guarantees earning £5 are all zeros. A subject who enters this answer has the ability to reason to an arbitrarily high level. Therefore, using the example above, if a subject chooses 31.8 in the GG and correctly answers the IGG, they show a high level of strategic thinking ability but a low-level belief about the strategic sophistication of their peers. 2.4. Individual level tasks. We use individual level tasks to collect data on cognitive abilities, risk preferences, and confidence. 10. 2.4.1. Risk preferences. Bomb risk elicitation task, BRET. To measure risk preferences, we employ the bomb risk elicitation task, BRET, Crosetto and Filippin, 2013. In the BRET, subjects are shown a screen with 100 boxes and are asked to choose to open a number of boxes, between 1 and 99. Each box contains 20 pence, therefore, earnings increase linearly with the number of boxes chosen. Among the boxes, however, there is one that, if chosen, makes the subject lose all their earnings. In the original version by Crosetto and Filippin, 2013, this box was described as a box containing a bomb. We used a more neutral description. 11. Since all boxes appear the same, the decision about the number of boxes is a decision under risk. A risk-neutral subject collects 50 boxes. A risk-averse subject collects less than 50 boxes and a risk-loving one more than 50. The more boxes a subject collects, the higher their degree of risk-seeking preference. BRET is the only task described in section 2.4 that is incentivized. 2.4.2. Cognitive ability, Raven's matrices, IQ. Our first test of cognitive ability is the Raven's 1941 progressive matrices test, perhaps the most well-known IQ test. We selected 18 of the most difficult Raven's matrices, available in Raven's Advanced Progressive Matrices, Raven, 1990. We did this to avoid a ceiling effect on the scores, which we did, as the highest score recorded was 15 out of 18. A subject's IQ score is the number of correct answers within a 10-minute period. 2.4.3. Cognitive ability, Cognitive Reflection Test, CRT. Our second test of cognitive ability is the Cognitive Reflection Test, Frederick, 2005. The test is designed to measure a subject's tendency to override an incorrect impulsive response and engage in further reflection that leads to the correct answer. For instance, one question is the following: a bat and a ball cost £1 and 10 pence in total. The bat costs £1 more than the ball. How much does the ball cost? An answer of 5 pence is correct while an answer of 10 pence suggests a lack of reflection. We use the extended 7-question version of the CRT Toplak, West, and Stanovich 2014. A subject's CRT score is the number of correct answers within a 5-minute period. 2.4.4. Confidence. After the Raven test and after the CRT, we present subjects with an 8-row table, in which each row reads, "What is the % chance that X of the 7 other participants had more correct answers than you did? For X equals 0, 1, to 7. In other words, we elicit the entire distribution of beliefs about the subject's ranking for each of these 2 cognitive ability tests. Given the subject's answers, for each test, we compute the expected number of outperforming subjects. The difference between the actual and expected numbers is our confidence measure for the subject. A positive number indicates that the subject is overconfident because they expected to be outperformed by fewer subjects than was the case. A negative number indicates that the subject is underconfident, and a score of 0 means that the subject is not biased. As we said, for each subject, we have this measure for both the Raven and the CRT test. We average these measures to get the composite measure of confidence, which we use in section 4.3. 3. Experimental subjects. We ran the experiment in the Experimental Laboratory for Finance and Economics, ELFE, in the Center for Finance at the Department of Economics at UCL. We ran 2 treatments, the trader treatment and the student treatment. The 2 treatments differ in the pool of subjects. In the trader treatment, the subjects are traders and portfolio managers working in London, UK. In the student treatment, subjects are UCL undergraduate students from all disciplines. We use the student treatment as our control treatment. Each treatment consists of 7 sessions. In each session, 8 subjects perform the tasks described above. Overall, our sample includes 56 professional traders and 56 undergraduate students. Subjects had no previous experience with this experiment and participate in 1 session only. Each session lasted approximately 2 hours. The subject pool for the trader treatment consists of 30 traders, 4 proprietary traders, 4 sales traders, 12 portfolio managers, and 6 belonging to other categories, for example, trading strategists or sales with management of virtual portfolios. 12. Subjects work in a variety of financial markets, such as equity, equity derivatives, FX, fixed income, and commodities. 32 subjects are employed by an investment bank, 12 by an investment fund and the others by other types of institutions, or chose not to report. Traders' age ranges between 22 and 48 years, with a mean of 32 years and a standard deviation of 6.17 years. Their average job tenure is 9.25 years, with a range between 1.5 and 21 years, standard deviation, 5.42 years. 3 subjects have an MPhil or PhD, 30 a master degree, 4 an MBA, 19 a bachelor degree. 30 subjects studied economics or finance, 8 mathematics or physics, 8 engineering or computer science, and the remaining have a degree in other disciplines or did not declare it. In our student treatment, we use UCL undergraduate students from all disciplines. We chose the gender composition of the undergraduate subject pool to match that of traders. In the trader treatment, 48 subjects are male, 86%. In the student treatment, 44 subjects are male, 79%. At the end of the experiment, subjects are paid based on their choices in the trading game, the GG, the IGG, and the Brett. In the trading game, we convert ECU into British pounds according to different exchange rates for the different treatments. For traders, we exchange experimental ECUs into British pounds at the exchange rate of £2.50 equals 100 ECU, whereas, for students, we exchange them at the exchange rate 25 pence equals 100 ECU. In the trading game, traders earned an average of £234.93, approximately equal to $306, with a standard deviation of £40.53, a minimum of £121, and a maximum of £401.33. Students earned an average of £23.35, approximately equal to $30.45, with a standard deviation of £6.06, a minimum of £7.84, and a maximum of £42.50. 13. 4. Results. We now describe the results of the experiment, starting with the trading game. We use professional traders in our experiment because of their expertise in trading and investing. 14. Our conjecture is that traders will trade at a price closer to the equilibrium predictions than will students. For example, traders will show a lower level of mispricing. This is our alternative hypothesis, which we test against the null hypothesis that there is no difference between the student treatment and the trader treatment. Throughout the paper, we use non-parametric tests run at the session level. That is, for each test, we use 7 observations for the trader treatment and 7 observations for the student treatment.